What if I told you that the world's most powerful currency, the one sitting in your wallet right now, might be going through the most significant transformation in over 80 years? The US dollar has been the undisputed king of global finance since 1944, but something fundamental is shifting beneath the surface. Central banks from China to Russia are quietly reducing their dollar reserves. Major oil-producing nations are exploring alternative payment systems, and the percentage of global transactions conducted in dollars has been steadily declining for the past 2 decades. Before you dismiss this as just another doomsday prediction, consider this. Every currency that has ever held global reserve status eventually lost it. The question is not if it will happen. History shows us it always does. The question is, are we seeing the early warning signs right now? If you want to understand the hidden patterns of money and what they mean for your financial future, you're in exactly the right place. Welcome to The Currency Truth, where we decode the forces shaping our economic reality. Before we dive deep into this critical topic, do me a favor. If you're serious about understanding how money really works and protecting yourself from financial uncertainty, hit that subscribe button and turn on notifications. The insights we share on this channel could genuinely change how you think about wealth and security. And if you find value in today's analysis, a quick like helps this message reach more people who need to hear it. Now, is the US dollar really losing its power? The honest answer is more nuanced than most headlines suggest, and understanding the truth requires us to look at historical patterns, current data, and the fundamental mechanics of reserve currency status. This isn't about fear. It's about clarity. To understand whether the dollar is losing power, we first need to understand what dollar dominance actually means and how it came to be. The US dollar's role as the world's primary reserve currency didn't happen by accident. It was the result of specific historical circumstances and deliberate policy decisions that fundamentally reshaped global finance. Let's go back to July 1944 in Bretton Woods, New Hampshire. World War II was still raging, but Allied nations were already planning for the post-war economic order. What emerged from that conference was the Bretton Woods Agreement, which established the US dollar as the anchor of the international monetary system. Here's what made it work. The dollar was pegged to gold at $35 per ounce, and other currencies were pegged to the dollar. The United States held the vast majority of the world's gold reserves at the time, roughly 20,000 tons, or about 60% of official gold holdings worldwide, making this arrangement credible. This system gave the dollar an extraordinary privilege. According to IMF historical data, by 1950, the US dollar represented approximately 55% of global foreign exchange reserves. But the Bretton Woods system contained a fundamental contradiction that would eventually tear it apart. The problem was identified by Belgian-American economist Robert Triffin in what became known as the Triffin dilemma. For the world economy to grow, there had to be an expanding supply of dollars circulating internationally. But the more dollars that circulated abroad, the less credible became the promise that they could all be converted to gold at a fixed rate. By the late 1960s, this tension reached a breaking point. The United States was running persistent trade deficits, partly due to the costs of the Vietnam War and expanding social programs. Foreign central banks began to question whether America had enough gold to back all the dollars in circulation. According to Federal Reserve historical records, foreign dollar holdings grew from $9 billion in 1950 to over $47 billion by 1970, while U.S. gold reserves had declined to about 9,000 tons. The math simply didn't work anymore. On August 15, 1971, President Richard Nixon announced that the United States would no longer convert dollars to gold at a fixed rate. This Nixon shock ended the Bretton Woods system and transformed the dollar into a pure fiat currency, money backed not by gold, but by the full faith and credit of the U.S. government and the strength of the American economy. Many observers at the time predicted this would end dollar dominance. They were wrong. In fact, the dollar's role actually strengthened. How did the dollar not only survive, but thrive after losing its gold backing? The answer lies in what happened next. In 1973, the United States negotiated an agreement with Saudi Arabia that would reshape global energy markets. The Saudis agreed to price their oil exclusively in US dollars and to invest their surplus oil revenues in US Treasury securities. In exchange, the United States provided military protection and support. This arrangement, which soon extended to other OPEC members, created what became known as the petrodollar system. Here's why this mattered so profoundly. Oil is the most traded commodity on Earth. According to the International Energy Agency, global oil consumption in the 1970s was approximately 55 million barrels per day. Every nation needed oil to power their economies, which meant every nation needed dollars to buy that oil. This created constant global demand for U.S. currency, even after it was no longer backed by gold. The petrodollar system essentially replaced gold backing with oil backing, or more accurately, with the backing of global energy demand. The numbers tell the story of dollar dominance in the post-Bretton Woods era. According to data from the IMF's currency composition of official foreign exchange reserves, the dollar's share of global reserves stood at approximately 71% in 1999, when the database began systematic tracking. Even more striking, the Society for Worldwide Interbank Financial Telecommunication, better known as SWIFT, reports that as of the early 2000s, roughly 68% of international payments were conducted in US dollars. For comparison, the euro, the second most used currency, represented only about 12% of global payments. This dominance extends beyond just reserve holdings and payment systems. U.S. Treasury securities, essentially IOUs from the U.S. government, became the world's safest and most liquid asset. According to Treasury Department data, foreign ownership of U.S. government debt grew from approximately $120 billion in 1974 to over $1 trillion by the year 2000. Countries accumulated dollars not just to buy oil, but because dollars and dollar-denominated assets represented the most secure store of value in an uncertain world. But here's what's crucial to understand. Reserve currency status creates extraordinary privileges, what former French finance minister Valéry Giscard d'Estaing called America's exorbitant privilege. Because the world needs dollars, the United States can borrow at lower interest rates than would otherwise be possible. Because global trade is conducted in dollars, American companies and consumers benefit from not having to exchange currencies or worry about exchange rate risk in the same way others do. And because the Federal Reserve effectively sets the baseline for global monetary policy, the United States has tremendous influence over worldwide financial conditions. Did you know that this exorbitant privilege is worth real money? Economists have attempted to quantify the benefit to the United States. Research published by the International Monetary Fund suggests that reserve currency status might reduce U.S. borrowing costs by approximately 0.3 to 0.5 percentage points. That might not sound like much, but applied to the roughly $28 trillion in total U.S. debt as of 2021, it represents savings of roughly $84 to $140 billion per year. That's the dividend of dominance, but every privilege comes with responsibilities and vulnerabilities. The very factors that created dollar dominance also created dependencies and resentments that are now beginning to shift the landscape. To understand whether the dollar is really losing power, we need to examine the specific warning signs that historical patterns tell us to watch for, and several of them are flashing right now. When a reserve currency begins to decline, it rarely happens overnight. History shows us that the process unfolds gradually, with specific warning signs appearing years or even decades before the final transition. To understand what's happening to the dollar today, we need to recognize these patterns and examine whether they're appearing in current data. The evidence is both fascinating and concerning. Let's start with the most direct measure, the dollar's share of global foreign exchange reserves. According to the International Monetary Fund's COFR database, the dollar's portion of allocated foreign reserves has declined from approximately 71% in 1999 to about 59% as of late 2023. That's a substantial drop of roughly 12 percentage points over just over 2 decades. Now, before you panic, context matters here. The dollar still dominates. The euro, its closest competitor, represents only about 20% of reserves. And the Chinese yuan still accounts for less than 3%, despite China being the world's second largest economy. But the trend is what matters. This isn't just statistical noise. It represents a deliberate, systematic diversification by central banks worldwide. According to the World Gold Council's 2023 Central Bank Gold Reserve Survey, 24% of central banks reported plans to increase their gold holdings over the next 12 months, while 71% expected their overall gold holdings to remain the same. Only 3% plan to reduce gold holdings. This represents a significant shift in central bank thinking about reserve composition. Here's where it gets interesting. The decline in dollar reserves is not just about central banks holding more euros or yen. It's about a fundamental fragmentation of the reserve currency system. According to analysis from the Bank for International Settlements, the share of reserves held in what they call non-traditional reserve currencies, including the Australian dollar, Canadian dollar, Chinese yuan, South Korean won, Singaporean dollar, and Swedish krona, has risen from approximately 2% in 2000 to nearly 10% by 2023. This diversification suggests that countries are hedging their bets, seeking to reduce dependence on any single currency. To understand why this matters, consider the historical parallel of the British pound sterling. In 1914, the pound was the world's dominant reserve currency, accounting for an estimated 60-70% of global reserves. Britain's economy was the world's financial center. London was the banking capital of the world, and the sun never set on the British Empire. Yet by 1950, according to research by economists Barry Eichengreen and Mark Flandreau, the pound's share of global reserves had fallen to approximately 40%, with the dollar surging to nearly 50%. By 1970, the pound represented less than 10% of global reserves. What caused the pound's decline? Not a single catastrophic event, but rather a series of weakening fundamentals. Britain's economy was devastated by 2 world wars. The country ran persistent trade deficits. Its share of global GDP declined from approximately 8% in 1900 to less than 4% by 1960, according to economic historian Angus Maddison's historical GDP data. Debt burden soared. By 1947, UK government debt reached roughly 270% of GDP, according to Bank of England historical data. Most critically, other countries lost confidence in Britain's ability to maintain the value of sterling, leading to repeated devaluation crises in 1949, 1967, and finally the complete abandonment of capital controls in 1979. Are we seeing similar patterns with the dollar today? Let's examine the evidence systematically. First, consider America's fiscal position. According to Congressional Budget Office projections, U.S. federal debt held by the public is expected to rise from approximately 97% of GDP in 2023 to 181% by 2053 under current law. That's a trajectory that resembles Britain's post-war debt burden. The annual federal budget deficit has exceeded $1 trillion in most years since 2009, according to Treasury Department data, and the national debt now exceeds $34 trillion. Second, examine America's trade position. According to the U.S. Census Bureau and Bureau of Economic Analysis, the United States has run a goods trade deficit every single year since 1976. That's nearly half a century of consistent deficits. The trade deficit in goods reached approximately $1.1 trillion in 2023. While the U.S. runs a surplus in services trade that partially offsets this, the overall current account deficit, which includes all trade in goods and services plus investment income, stood at approximately $800 billion, or roughly 3% of GDP. Have you ever wondered why persistent trade deficits matter for currency strength? Here's the mechanism. When a country imports more than it exports, it must send currency abroad to pay for those imports. Under normal circumstances, this would weaken the currency. Too much supply in foreign hands would reduce its value. But the dollar's reserve status creates a circular flow. Those dollars come back to the United States through purchases of Treasury securities and other investments. According to Treasury Department data, foreigners hold approximately $7.6 trillion in U.S. Treasury securities as of late. 2023, roughly 30% of the total debt held by the public. This arrangement works wonderfully, till it doesn't. And here's the third warning sign. Countries are finding new ways to conduct trade without using dollars. According to Bloomberg analysis, China and Russia settled approximately 90% of their bilateral trade in rubles and yuan in 2023, up from virtually zero just a decade ago. The United Arab Emirates and India have begun settling certain oil trades in rupees. Brazil and China have negotiated direct currency swap arrangements to facilitate trade without dollar intermediation. The numbers are still small in absolute terms. According to SWIFT data, the yuan accounted for approximately 4.5% of global payments by value in late 2023, compared to the dollar's roughly 48%. But the trajectory is significant. In 2010, the yuan represented less than 0.1% of global payments. That's a 45-fold increase in just over a decade. Perhaps the most significant development is the expansion of China's cross-border interbank payment system, known as CIPS. According to the People's Bank of China, CIPS processed approximately 130 trillion yuan, roughly 18 trillion in transactions in 2023, connecting over 1,400 financial institutions across 109 countries. While this is still a fraction of the $150 trillion in daily transactions processed by the dollar-based SWIFT system, according to Bank for International Settlements data, it represents an alternative infrastructure that didn't exist 15 years ago. Here's what history shows us. The infrastructure of finance matters as much as the economics. The pound sterling maintained reserve status for decades after Britain's economic decline began, partly because the infrastructure of global finance ran through London. Similarly, the dollar benefits from deep, liquid markets and established payment systems. But once alternatives exist, transitions can accelerate. Consider the energy market, the foundation of the petrodollar system. According to data from the Chinese government, China has paid for certain oil purchases from Saudi Arabia in yuan rather than dollars. The volume is reportedly limited. Most Saudi oil sales remain dollar-denominated, but the precedent is significant. According to the International Energy Agency's World Energy Outlook 2023, China is the world's largest oil importer, consuming approximately 16 million barrels per day. If even a portion of China's energy imports shifted away from dollar settlement, it would reduce global dollar demand by tens of billions annually. The Federal Reserve itself has acknowledged these shifts. In a 2023 research paper, Federal Reserve economists noted that the dollar share of global reserves has declined, especially since 2016, while the shares of non-traditional currencies have risen. They attribute this partly to what they call active diversification, by central banks seeking to reduce concentration risk and geopolitical exposure. That last phrase, geopolitical exposure, points to perhaps the most powerful force driving dollar diversification, the weaponization of the dollar-based financial system. After Russia's invasion of Ukraine in 2022, the United States and European allies imposed unprecedented financial sanctions, freezing approximately $300 billion in Russian central bank reserves, according to U.S. Treasury data. These reserves were held in dollars and euros and became inaccessible overnight. The effectiveness of these sanctions sent a clear message to every other country. Holding reserves in dollars subjects you to potential U.S. policy decisions. According to survey data from the official Monetary and Financial Institutions Forum, 58% of central bank reserve managers indicated that the Russia sanctions have made them reconsider the currency composition of their reserves. That's not speculation. That is, central bankers explicitly stating they are rethinking dollar dependence because they witnessed reserves become a policy weapon. This video is for educational purposes only. It does not constitute financial advice. What we're examining here are observable trends and their historical context, not predictions or investment recommendations. The data shows real shifts occurring in the global monetary system. But understanding these shifts requires us to also examine what they mean in practical terms, which brings us to our final section. So, we've established that the dollar's dominant position is showing measurable signs of erosion. But what does this actually mean? Does it mean the dollar will collapse? Should you panic and convert everything to gold or foreign currencies? The answer is far more nuanced, and understanding the realistic implications is crucial for making informed decisions about your own financial security. First, let's address what this is not. This is not a prediction of imminent dollar collapse or hyperinflation. The historical pattern of reserve currency transitions shows us that these processes typically unfold over decades, not months or years. When the British pound lost its reserve status to the dollar, the transition took roughly 30 to 50 years, depending on how you measure it. The pound began declining from its peak around 1914, but still represented approximately 40% of global reserves in 1950. Even today, the pound remains a respected international currency, just no longer the dominant one. What we are likely witnessing is the beginning of a transition from a unipolar monetary system, where one currency dominates overwhelmingly, to a multipolar system, where several currencies share reserve status. According to analysis from the European Central Bank, this multipolar future might include the dollar, euro, yuan, and potentially digital currencies or special drawing rights from the IMF, playing significant but not dominant roles. Here's what this transition could mean in practical terms. According to research by economists at the Peterson Institute for International Economics, if the dollar's reserve share declined from its current approximately 59% to, say, 40% over the next 2 decades, the United States would likely face higher borrowing costs. Their estimates suggest that interest rates on U.S. government debt could rise by approximately 0.3 to 0.8 percentage points. That might not sound dramatic, but applied to tens of trillions of dollars in debt, it represents hundreds of billions in additional annual interest payments, costs that would ultimately be borne by taxpayers through some combination of higher taxes, reduced government services, or increased deficits. For everyday Americans, reduced dollar dominance could manifest in several ways. First, imported goods could become more expensive. The dollar's strength has historically kept import prices low. According to Bureau of Labor Statistics data, the price index for imports has grown much more slowly than overall inflation over the past several decades, partly because of the dollar's purchasing power. If the dollar weakens relative to other currencies, that $1,000 smartphone assembled in China or that $30,000 car with components from Mexico and Canada could cost meaningfully more. Second, international travel could become pricier. According to data from the U.S. Travel Association, Americans took approximately 93 million international trips in 2019, pre-pandemic. A weaker dollar means your money buys fewer euros, yen, or pounds when you travel abroad. That European vacation or Asian business trip becomes 10%, 20%, or 30% more expensive in dollar terms if the currency weakens significantly. But here's what's crucial to understand. Currency transitions also create opportunities, and understanding them positions you to adapt rather than simply react. Let me share some educational perspectives on how informed individuals and institutions are thinking about this shift, keeping in mind this is educational information, not financial advice, tailored to your specific situation. First, diversification becomes more important in a multipolar currency world. According to modern portfolio theory, which won the Nobel Prize in economics, diversification reduces risk without necessarily reducing returns. In a monetary system where the dollar is less dominant, holding some assets denominated in other currencies, whether euros, Swiss francs, or even small positions in emerging market currencies, can provide a hedge against dollar weakness. Financial institutions and sophisticated investors are already doing this. According to the IMF's Coordinated Portfolio Investment Survey, cross-border investment in foreign securities by U.S. investors reached approximately $11.6 trillion by 2022, up from roughly $4.2 trillion in 2001. Second, hard assets and commodities historically perform well during periods of currency uncertainty. According to data from Macro Trends, gold has preserved purchasing power over very long time horizons despite short-term volatility. From 1971, when the dollar left the gold standard, through 2023, gold prices rose from $35 per ounce to approximately $2,000 per ounce, an increase of roughly 5,600%. Meanwhile, according to Bureau of Labor Statistics data, the Consumer Price Index rose by approximately 650% over the same period. That means gold significantly outpaced general inflation, though with substantial volatility along the way. Have you ever wondered why central banks themselves are increasing gold holdings if it's just a barbarous relic, as economist John Maynard Keynes once called it? The answer is that gold has no counterparty risk. It's not anyone else's liability. According to the World Gold Council, central banks added approximately 136 tons of gold to their reserves in 2022, the second highest level of annual purchases in over 50 years. The People's Bank of China, the National Bank of Poland, and the Central Bank of Turkey were among the largest buyers. These institutions are hedging against the very uncertainties we've been discussing. Third, developing skills and knowledge that transcend any particular currency becomes invaluable. This might sound philosophical, but it's intensely practical. According to research from the World Economic Forum, the most resilient individuals and communities during economic transitions are those with diversified skills, adaptable businesses, and strong networks. Your human capital, your knowledge, skills, relationships, and adaptability cannot be devalued by monetary policy or geopolitical shifts in the same way financial assets can. Now, let's address the question. Could this transition accelerate into something more dramatic? Could we see genuine dollar collapse rather than gradual decline? History provides some guidance here. According to research on currency crises by economists Carmen Reinhart and Kenneth Rogoff, rapid currency collapses typically require a combination of factors: unsustainable fiscal policy, loss of central bank credibility, a sudden stop in capital inflows, or a major external shock. The United States certainly faces fiscal challenges. The $34 trillion national debt and persistent deficits are real, but several factors distinguish the U.S. from countries that have experienced currency crises. First, according to Treasury Department data, approximately 76% of U.S. government debt is held domestically or is owed to U.S. government accounts like Social Security. This internal ownership provides stability. Americans aren't going to suddenly abandon their own currency en masse. Second, the Federal Reserve maintains credibility and independence. According to research published in the Journal of Economic Perspectives, central bank independence strongly correlates with price stability. Despite political pressures, the Fed has consistently acted to maintain that stability, most recently by raising interest rates aggressively in 2022-2023 to combat inflation, even at the cost of slowing economic growth. Third, the U.S. economy remains innovative and productive. According to World Bank data, the United States still produces approximately 25% of global GDP, despite representing only about 4% of the world's population. According to the Global Innovation Index published by the World Intellectual Property Organization, the U.S. consistently ranks among the top countries for innovation, technological advancement, and research output. This productive capacity ultimately backs the currency. But, and this is important, none of these strengths are permanent or guaranteed. According to Congressional Budget Office long-term projections, current fiscal policy is unsustainable, and without changes, debt-to-GDP ratios will reach levels historically associated with financial instability. The question is whether political systems can implement necessary adjustments before credibility erodes. So what should you actually do with this information? Here are some educational principles that financial experts generally recommend, though remember you should consult with qualified financial advisors for personal guidance. First, maintain an emergency fund in cash, typically 3 to 6 months of expenses, according to guidance from organizations like the Consumer Financial Protection Bureau. Currency transitions unfold slowly enough that cash remains useful for immediate needs. Second, consider diversification across asset classes. According to research from Vanguard and other investment firms, a diversified portfolio typically includes some combination of domestic stocks, international stocks, bonds, real estate, and perhaps alternative investments. The specific allocation depends on your age, risk tolerance, and goals, but the principle of not having all your eggs in one basket becomes even more important during monetary transitions. Third, invest in yourself. According to data from the Bureau of Labor Statistics, individuals with bachelor's degrees earn approximately 67% more over their lifetimes than those with only high school diplomas. Skills, education, and professional networks provide returns that persist regardless of which currency dominates global finance. Fourth, stay informed but avoid panic. According to behavioral finance research, emotional decision-making during market volatility typically destroys wealth rather than protecting it. The investors who sold everything during the 2008 financial crisis and moved to cash locked in losses and missed the subsequent recovery. According to data from Dalbar's quantitative analysis of investor behavior, the average investor underperforms the market significantly, primarily due to emotional buying high and selling low. Let's ground all of this in the most likely scenario based on current evidence. The data suggests we're in the early stages of a gradual transition from dollar hegemony to a more multipolar monetary system. This transition will likely unfold over 20 to 40 years rather than 2 to 4 years. According to projections from the Atlantic Council's Dollar Dominance Monitor, the dollar could decline from approximately 59% of global reserves today to perhaps 45% by 2040-2050, with the euro, yuan, and other currencies filling the gap. During this transition, Americans should expect some combination of higher borrowing costs, somewhat higher inflation, more expensive imports, and reduced international purchasing power. But these changes would likely be gradual and manageable, rather than catastrophic. Think slow erosion rather than sudden collapse. The good news is that understanding these patterns gives you time to prepare and adapt. History shows that individuals and institutions that recognize major transitions early can position themselves advantageously. Those who understood that manufacturing would shift globally in the 1980s adapted their careers and investments accordingly. Those who recognized the internet's transformative power in the 1990s benefited enormously. Similarly, understanding the gradual evolution of the global monetary system provides opportunities to make informed decisions. Here's what I want you to take away from this analysis. The US dollar's dominance is diminishing measurably. But this is a process, not an event. The trends are real. Declining reserve share, increasing central bank diversification, alternative payment systems gaining traction. But the timeline is measured in decades, and the outcome is more likely a multipolar currency world than dollar collapse. The wisest approach is informed preparation without panic. Understand the patterns, diversify thoughtfully, invest in skills and knowledge, and stay adaptable. The world's monetary system is changing, but change also creates opportunity for those prepared to recognize and respond to it. If you found this analysis valuable, do me a favor. Share it with someone who would benefit from understanding these patterns. Hit that like button to help this reach more people who need clarity rather than fear-mongering. And subscribe to The Currency Truth if you haven't already, because we'll continue tracking these developments with the same data-driven, historically informed approach. The future of money is being written right now in central bank decisions, geopolitical shifts, and economic trends. Understanding that future gives you the power to navigate it successfully. Thanks for watching, and I'll see you in the next video where we decode the forces shaping our economic reality.